Can we talk about downside here? 38.50 right now on the screen on the S&P. You're thinking closer to 3K as a bottom for next year?
And John, we've been very consistent about that, right? I mean, we've been in this sort of 3,000 to 3,300 range since really May. We put our mid-year outlook out. That's the path. And we think that's still the path. And I would say that we now believe we could get to the lower end of that path simply because you worked off kind of this bearishness in the last 2 months. I mean, the bear market rally we had did its job, right? Its job is to, it's like a 3-card Monte. Look over here, and then all of a sudden you forget about looking over on this one. And then that's when you get surprised. So, the setup's good for a finishing move to this bear market. That's the bad thing. The good thing is we're closer to the end than the beginning.
Mike, as you get more bearish on earnings, do you get more bullish on bonds?
Well, we've been bullish on bonds since the summer. We were probably a little early on that call, but it's worked out pretty well. I think, that's one thing that's different too this time, John, whereas like in 08, we're not going to have a systemic risk like we had in 08. In our view, anything's possible. That's our general take right now. That's good. However, the Fed cannot be as accommodative, right, as they have been historically because of this underlying inflationary issue, which is new in the investment community for the last 30 years. So that's one other thing we'll be watching closely in the spring. How fast does the cavalry come riding in, even in the event of a labor cycle? I think they're going to be slower. They've told us that, and that could be the surprise and why we can get to those lower price levels on the S&P 500.